Welcome to Retirement Mentorship, your mentor to and through retirement. I'm your host, Freeman Lindy, certified financial planner. On today's guest on podcast, I got to be on the Financial Freedom podcast with Dr. Lou. He was a doctor, a full-on physician who left his practice to start his financial planning journey or his financial blogging journey. So now he just full-time interviews people and teaches doctors how to live financially free and does a lot of great work. And so I got to be on his podcast as an expert and discuss all kinds of different things. So I hope you enjoy this interview on the Financial Freedom Podcast. Again, for any of these guests on podcasts, you can find links to the podcast itself in the show notes of this episode. And so if you want to give that podcast a try, you can feel free to do that. We'll see you soon. Cheers.
Hey guys, welcome to this week's podcast episode. And I've got a fantastic business guest for you today, Freeman Lindy. And he's going to talk to us all about finance, retirement, investment strategies, tax efficiency, holistic financial planning. He's going to talk about ethical financial advice. And I'm happy to welcome him to the show. So Freeman, welcome.
Hey, thank you. Appreciate being here.
Yeah. Talk about your early experiences, what you learned, and how it got to be what you do today.
Yeah, well, I started off in the financial advice industry, kind of under an insurance umbrella. I didn't really know it at the time, what the difference was between the types of advice that were out there. And so I started off with a firm that had, they pretended to be an all-inclusive advice, planning. We do investments, we do planning, we do insurance, all these things. But in the background, right, they had insurance quotas of a certain amount of policies or premium you need to sell and all those things. So all their training, all their focus was on the insurance side. And insurance can be great, right? Some people need it, some people don't. All of us need certain types, but there's a lot of other types that we don't need. And I just was always kind of uncomfortable with some of those things. My initial background of getting into finance was reading Dave Ramsey's Total Money Makeover, right? And he's always talking about, whole life is the payday of the middle class and payday lender of the middle class and some of these other things. But then you'd have other smart people in the company that had CFP and MBA and all these big titles behind their names that would say, no, whole life is great. Here's all the things that it does. And so you're like, okay, so you got a radio personality over here saying one thing and supposed experts over here saying another thing, and which is right. And I just ended up doing a lot more study outside of that and learning kind of, what are some really core financial planning strategies beyond what the insurance company is training me for, right? Got my certified financial planning designation, the enrolled agent tax license to do taxes and some of these other things. And one of the things that I found, right, in going through these is that the only people that recommend using permanent life insurance are the people that sell it and get paid huge commissions to do it. And so you can find experts in the field that recommend it because they sell it. And all the other experts, or all the personal bloggers, all the, anyone else who's not being paid a big commission does not recommend it, right? And so I was like, what is going on here, right? And so you start to see the reason behind why recommendations are made. And so just through some of that study and then trying to continue to push these products, I decided, I can't do the business the way I want to do it under this umbrella. I want to go independent, learn more about starting a business. What are all the things that are involved in the back end of that? And ultimately launched my own practice back in 2021. And it's just been amazing since. And you obviously know the feeling of going from kind of more of a corporate, setting to being able to do what you want and run your business the way you want to. And I'll never go back. It's been amazing.
Yeah. And it's quite interesting because I've talked to a number of other financial planners, and they're actually doing what you're doing, kind of branching out, focusing on certain niches, the dual income, no kid couple, no kids, different strategies.
Yep.
So in this whole idea of retirement readiness, I'm really worried for my kids, they're like the whole like Gen Z generation, because financial literacy is not taught, and you see this wealth gap getting bigger, so and people just getting more and more in trouble. So what are the most common misconceptions about preparing for retirement? How do you address them with your clients?
Yeah, I think one of the big issues that I see is people just not really understanding the different types of investments out there. And it doesn't take a lot, right? I mean, to your point, right? This is just not taught anywhere. And I think everyone should have just at least a basic understanding of some of these things. Obviously, you can go much deeper. You can become an expert yourself. There's strategies to get you much further. But you can get 80% of the way there with just a few decent principles, and then you can spend a lot more time to try to optimize that last 20%, which is where someone like me would come in. But so, for instance, one thing that a lot of people are in, most of their retirement stuff goes into like their 401k through work, right? And maybe they're doing a Roth IRA on the side or those types of things. But for most people, the way that they choose their investments is they fill out what's called a risk tolerance questionnaire, which is where they spend 5 minutes and ask them a bunch of questions like, hey, if you had these 4 investments, which one you choose based on these? And if in the market dipped by 20%, what would you do? And some of these kind of things. And they're sitting in an office or on their couch at home or wherever they're taking this, which is not at all the real scenario of what you would actually be facing when you face these situations. And they're just filling it out, and they take 5 minutes. And in 5 minutes, that 5 minutes determines their entire financial future, because that 5 minutes is going to then base their entire portfolio off of what you did there, right? And it'd be kind of like someone coming into a hospital saying, hey, I've got some issues, right? And they're like, okay, well, here, quick, fill out this 5-minute form, and then we'll write you a prescription. We'll send you on your way. And like, what? No tests, no no questions, no diagnostics, no nothing. You're just gonna like write a prescription and send me off. Like that. That's not the way that it should be done professionally, right? And so most people spend more time, right, planning their weekend plans or what they're going to have for dinner than they do planning out their whole financial future. Yeah. And the problem with these risk tolerance questionnaires is, they don't work, because the whole point of them is to try to say, well, hey, what's your tolerance for risk? Right? How much volatility can you stomach in the market? And if you have if you're more conservative, I hate using these words because people have different interpretations of what they mean, but if you're more conservative, they're going to put you more into bonds and cash and less into stocks. And if you're more aggressive, they're going to put you more into stocks. But when you have things like the COVID crash, right? We all remember that, right? 35% down in 33 days, fastest crash in US history. The reason that the stock market went from 30% down to 31% down is because people were willing to sell at 30% down. Right. And the reason it went from 31% down to 32% down is because people were willing to sell. Like, hey, I think this is going to keep going down. I'm going to get out of the market. I'm going to sell my shares in my stocks 30% off and take that huge loss because I'm afraid it's going to go down even further. And so all these people, like people say, well, people don't sell out in the bottom of the market. Yes, they do. That's why the market keeps going down. It's because people are selling and they're getting out at the worst possible time. They bought in high and now they're selling low. And 100% of people who did that in COVID or who sold out in 2022 when it was going down because of Russia and inflation and all these other things, 100% of people who did that filled out a risk tolerance questionnaire, because you can't invest without doing that, right? And so they were all invested appropriately, quote unquote, for the podcast audience, that they were supposedly, they've done their planning, they've done their homework, they've done their risk tolerance questionnaire, and now their investments are perfectly suited for their goals. But actually, they don't understand investing at all, which is why they're selling low and doing those things. And so they don't work in the first place. The only reason they're there is to CYA, cover your butt for the investment companies that say, well, hey, if you lost money in the market, look, you filled out this risk tolerance questionnaire, we invested you according to it, so you can't blame us if you don't like your results. That's the only reason they exist. And for the vast majority of people out there, from Gen Z people just getting their first job to, we've seen, doctors with millions of dollars in their portfolios come in, and it's in a target date fund. And the only reason it's there is because they filled out a risk tolerance questionnaire 20, 30 years ago, and they've never looked at it since. Mm-hmm. Right. And that is now determined. Now they've given up hundreds of thousands, if not millions of dollars over their lifetime, because they only spent 5 minutes doing this instead of truly understanding the difference between stocks and bonds, and really understanding what volatility is and what the ups and downs of the market is and what that means, and especially what it doesn't mean. Right. So, get educated. And that's why I like podcasts like yours and all these other ones that are the goal out there is to help people get that education that we're not getting in school. Right. And that's what I think we need more of.
Yeah. The other thing that concerns me is this level of government debts, not just the United States, but everywhere, like worldwide. And like you, me, our kids, we're on the hook for that. And so essentially just basically government printing money, manipulating interest rates. It's really volatile. And so a lot of people are saying, a lot of the younger generation, they're saying, screw this, bonds. I don't, bonds aren't going to do anything for me. Stocks are so volatile, and they're saying like 60/40 doesn't work, and all these models are just outdated. So how do you, when you're working with younger clients, how do you address their concerns? Because a lot of these principles are from kind of our Gen X and the boomer age, and it's a lot of that's changing with technology and different economics. So how do you address those?
Yep. I think what I try to do with my clients and my audience too is just to help people. Like, I'm not out there looking for the quick fix or the one unique way to make way more money than anyone else, or the one investment strategy or crypto or these kind of things, right? Like, there are people out there who are dedicated to that. And
Yeah.
if that's what you want to do, right, if you want to try to be one of the 0.01% of people that get rich out of luck or out of picking the right investment or getting on the ground floor or something, like, you can try that. Right? Those odds are not good. Those odds are not in our favor. And so I don't try to play that game. What I try to do is teach people, hey, here are proven principles for building wealth. They've worked for everyone who has done them successfully. Right now, again, you have to do two things, right? You have to know how to do it, and you actually have to do it all the way through. And
Yeah.
a lot of people we just talked about don't know how to do it, or once they find out, they give up halfway through or at the worst possible point. Right? Because, for instance, if you're investing in stocks, yeah, they're volatile and all these things. And so if you give up at the wrong time and pull out when it's down, because you're like, oh, this doesn't even work. I keep losing all my money, quote unquote, all my money in the stock market. Then you're not really doing the plan. You're not really investing the way you were supposed to.
Mm.
And so for me, it's we're not investing in the stock market, like this weird entity out there that's kind of nebulous, and it's people out there waving pieces of paper on the New York Stock Exchange floor and yelling buy and sell and all these things, and trading and doing all these things. What we teach is, hey, if you want to be wealthy, if you want to build wealth and independence, there's only one way that's been proven to do that, and that is to be an owner. You want to be an owner, not a loaner. If you look at all the wealthiest people that are out there,
Mm.
from the ultra wealthy to just regular, just well-off people in your neighborhood, in your city, wherever else, the people that have the wealth are the ones that own the businesses,
Mm.
right? Even people another great way to do it is to own real estate, right? But again, you're an owner of the real estate, and you can especially make money if you treat ownership of real estate as a business, and you
Mm.
own a business that's in the business of real estate. Either way, you're an owner, you own real properties, you own real value, and you get to reap those profits of it. You can, of course, start your own business like I did, like you did, like a lot of other people I know have left their corporate careers to start a business, and that can be very successful. But
Mm.
obviously, not everyone has that entrepreneurial bug, that entrepreneurial gene. Not everyone has the time to invest in doing real estate the way that you need to do it right. But anyone can still be an owner by being an owner in the best business in the world that are already publicly available for all of us to own.
Yeah.
Right? When we teach investing, we don't mean that we are investing in the stock market. Instead, we say, hey, we are business owners in the best businesses in the world. That we are co-owners of the best business of the world. And when you own those best businesses by owning shares of those, by owning, equity in those companies, you get to share in the profits and you get to share in the ups and downs, like any business owner. Right. And all business owners would tell you, like, yep, I built all this wealth with my business, and there were some bad times, and there were some tight times, and cash flow was tight, and we had to lay people off, and we had to do this and that and that. But we prevailed, and now we've built all this wealth because of it. And that's
Mm.
the same way that all the publicly traded companies work too, that if you invest in them and if you have the mindset of, I'm going to own these companies like a business owner, and I'm going to get those profits, those dividends. Sometimes the dividends are going to be less when profits are tighter. Sometimes they're going to be more. Sometimes we're going to have periods of temporary decline in value, right? We don't lose money when we're business owners. Instead, we have a temporary decline in value of our companies. But those
Mhm.
will always come back as long as you hold on. Then you get to reap the rewards of that roller coaster.
Yeah.
And the alternative, right, is that you can be a loaner. You can loan your money out to banks to get CDs and money market accounts. You can loan it out to governments or other businesses and get interest rates and bonds and treasury bills. But
Yeah.
that's not how you build wealth. You can get
Mhm.
a little bit of interest, a little bit of money here and there doing that. The real money comes from owning things, either real estate or the best businesses in the world. And those are truly the way to build wealth. It's not overnight. It's not necessarily even that complex, but it is hard to do day after day, month after month, year after year. And that's where I think, right, having a plan, sticking to that plan, and truly believing in the long-term success of that plan is crucial to making that happen.
Yeah, it's I love your answer because like I said, people like I was listening to this podcast and like they were saying like last year 108 billion was spent on lotto tickets and just people looking for that that quick home
Yep.
run and this rich get rich quick and a lot of it is just habits. It's like it doesn't take you. It's basically you save, you live under your means, you save, you invest. And again, very stable things, real estate, stocks, companies, equities, good companies. And then, if you want to dabble in, whatever Bitcoin and these other things, but don't like make that your
Right.
retirement nest egg. So, yeah.
Absolutely. If you got something on the side that you want to do, right? Hey, I've got my core portfolio, I've got my core wealth building strategy that I'm putting most of my money into. And if you have a little side play account that you want to test cryptocurrency or NFTs or whatever the latest technology is, right? Then
Yeah.
that's fine too. But I've seen a lot of people bet the farm on, or bet all their retirement on one strategy. And when that doesn't pay off, that's pretty hard to come back from. So
Yeah. I know so I really love your approach and I love how you talk about ownership and the wealth is created through ownership, business ownership. Um so one thing is your approach to fiduciary and you basically talk about you are a fee only fiduciary financial planner. Some people don't know the difference in so kind of talk about how you work and how you're different from the mainstream.
yeah, so there's two main models of advice that are out there. And so again, if you know this, great. You're one of the few people that know this. And once you know this now, if you don't, then you'll never go back, right? So there's two main models. There's what's called the suitability model and the fiduciary model. And under the suitability model, basically what that means is that a financial professional who's giving you advice, right? You say like, hey, I don't want to do all this myself. Hey, that sounds great. Being a business owner of companies, investing in the stock market, I still don't have time to do that, right? I'm working with patients. I'm trying to live my life with my family, like whatever else. I want to delegate that to someone else. Um, and so you can find the vast majority of professionals out there fall under what's called the suitability model, where you come to them, you say, hey, I got all this stuff. Give me some advice. Tell me what I should do with it. And under suitability, they only need to tell you what is good for you. They don't need to tell you what's best for you. I got this money to invest or whatever, and they've got option A and option B. And option A is really good for you. It's the best possible thing for you to do, but it doesn't pay them very much. And
Mhm.
option B is good for you. It will improve your situation, but it pays them a ton. They don't even have to talk about option A. They can just say, "Hey, I've got this great option B. It's amazing. You should do this." And then you invest that way. They get paid a huge commission. They ride off into the sunset, and you're stuck with an inferior strategy or an inferior product or whatever else, right? Under the fiduciary model, they're ethically and legally obligated to only give you what's called best interest advice. They can only tell you what to do if it's in your best interest, not merely good for you. So if they have option A, same option B, because option A is clearly best for you, they wouldn't even bring up option B, even though it pays them more money. They would just say, "Yep, hey, option A, this is the way to go." And then a further distinction with that, though, is now there's a lot more people that claim, "Yeah, I'm a fiduciary, like I give fiduciary advice." But even in that, there's some trickery that happens in there. I had to do two podcast episodes on this just to explain the whole part of it. But um, where they can basically say, "Hey, I'm a fiduciary with some of the things that I do for you, but not necessarily a fiduciary on everything I do for you." Right? Instead of a fee only financial advisor, that means maybe they're charging you a fee to do some planning, or maybe they charge you a fee to manage your investments, right? They don't make any commissions off your Roth IRA, off your backdoor Roth, off your brokerage account. They earn a fee on that account, maybe an assets under management or a flat fee. And because they're charging you a fee on those accounts, they are legally obligated to be a fiduciary on those accounts, but not necessarily on the other advice that they're giving you in your total financial plan. If you read the fine print on financial planning agreements that you can do with some firms, right, they're 70 pages long. They make them super long so that you won't read them. And right in there, it'll say, "Hey, when we're doing this, or when we're managing your investments or giving you a financial plan, we're acting as a fiduciary. But when we're giving you specific recommendations around insurance, we're no longer acting as a fiduciary. Instead, we're acting as an agent of the company to recommend this insurance product." Right? So they can claim fiduciary status, tell you all these great financial planning things and say, oh, and also you should invest in this whole life policy or this, do some infinite banking with this universal life policy or whatever the new scam is, right? And so one way to avoid that, right? Because when you think about it, like I've never met anyone who hears the difference between suitability and fiduciary and is like, nah, suitability is fine. I just want like mediocre advice, right? I just want like advice. No, like everyone wants the best advice, right? And so you're always going to want fiduciary, but you want to make sure it's fiduciary across everything that you have and not just part of it. And so that's where like the fee only part of fiduciary comes in, where people who are fee only, they only get paid a fee. There's a whole, it's not just me, right? There's a whole bunch of us out there. We're the minority. There's like we're like 1% of the total financial advisors that are out there, but there's a bunch of us that we only get paid a fee. We don't make any commissions. We don't earn any kickbacks. In order to qualify for this level, no one that's related to me or works in my firm can get any commissions or kickbacks. Right. So I can't have my wife be an insurance agent and then like, hey, I don't, but then I recommend her over to her and then she sells you the insurance. It's like a couple spaces removed to make sure that there aren't those conflicts of interest and that anything that a fee only fiduciary tells you, you can trust is in your best interest because you already know what you're paying them. You're paying them for best interest advice. They have no additional incentives to recommend any other products or strategies outside of what's best for you. And that to me is just the main difference between, right, the true advice, because you want really good planning advice versus someone who's just out there to sell up a product or a strategy or something like that.
How can people get in contact with you, check you out, book a call, see your work, etc.?
Yeah, I think the best way is to just look at my podcast and work on, it's called Retire Mentorship. It's one word, Retire Mentorship. Just retirementorship.com. We have a podcast, workbook, some magazines. I wrote a book that's on there too. You can get that for free. And I always think it's good to, even if you don't have to work with me, right? You can find other fee only advisors in your area or that specialize in your line of work. But yeah. I think what we try to put out then is just good educational advice to build that knowledge and the things that you should be doing, build your belief and actually sticking with the plan, and then also inspire you to actually act on that plan. Because as you and I know, right, you can know all this great stuff about finances, but if you don't do anything about it, then it's all for nothing. And so that probably just, tuning into more podcasts like this, finding things to do, finding the best way to do it, and actually acting on that is going to be crucial. Just find me on retirementorship.com, and that's probably the best way.
Yeah, I love that. And for all the audience, let's thank for a wonderful podcast episode, and be sure to check out Freeman's socials, give him a like and follow, check out his he's also the book 3D Retirement Income, check that out, as well as his website, his services. And with that, thanks so much for coming on.
Awesome, Dr. Chris, appreciate it. Thanks a lot.